Thank you, Julia, and thank you for inviting me to speak at this conference to the team of Wharton and the Pension Research Council. So until today, and essentially the session before, we didn't hear the word client or member preferences. But now we're going to talk about that because that's actually missing in this discussion. What do all these people that buy financial services actually want themselves? And how do we measure that, if we should measure it at all? So what I did with my colleague Paul Smeets is to think about what drives the sustainable investment agenda of pension funds. So I'm going to focus on pension funds, although many of these topics are also relevant for the mutual fund sector and institutional investments. So if you think of it, what does drive it? It's obviously a legal and a social context that drives it, both hard and soft law. So what I heard yesterday and even today is very US centered. So your interpretation of the topic of fiduciary duty is grounded in the prudent investor rule. Europe's interpretation of fiduciary duty is grounded in the same prudent investor rule, but still we interpret duty of loyalty and duty of care completely differently. I'm going to tell you a bit about that. So if you have different social and legal contexts, you will probably also need to offer different products. The question is only, how do you get there? Then there's also peer pressure going on. So, Sam Hartzmark's paper recently showed that that information of Morningstar globes on the sustainability of funds really determines the fund flow into these funds. So benchmarking between mutual funds, but also benchmarking between pension funds happening heavily in the Netherlands impacts the way you drive your sustainable investment agenda. Then more micro, there's also the size of the fund. You have more material, more potential to invest, whether how you should actually invest sustainably if you're a large fund and if you're a small fund. Then board members have their own preferences. They may not realize it, and they also have their own beliefs on the topic. So that will impact how you drive your investment agenda. And we learned from finance literature that also the composition of boards impacts how you decide on investments, so also on ESG investments. But about beneficiaries' preferences in the context of pensions, you don't really hear a lot. So that sort of got me into this topic. I'm in this topic of ESG and finance for quite a while, but I was puzzled about why are we not checking out what people actually want? And, luckily, Billy already talked about this a bit, but the way I would in a stylized way talk about sustainable investing, it's either exclusion, divestment, or some kind of integration, whether you call it simple integration or impact investing or whatever, into the investments, or you are an active owner and you get engaged with companies in different ways. But in all three of those, there are elements of non-financial motives, even in the second one. And then the question is, how do you measure that? If you do this, if a board of a pension fund makes these decisions, how do you get to a decision? Again, Billy talked about the DOL, the Department of Labor statements. I was really struck by that when I saw this. I started researching for this chapter. I looked at the US, I looked at the UK, and I looked at Europe. I don't have to repeat what Billy just said on the US, very strict. Of course, Biden probably will open it up again. And the UK is a bit in the middle. I think Canada as well. But in Europe, we have a completely different way of looking at this. So let me give you an example. The European Sustainable Finance Action Plan requires quite a lot from both companies and investors to disclose on how they invest. They even require mutual funds next year to ask their clients their sustainability preferences and make these portfolios of these clients consistent with these preferences. And if they do not, they breach their duty of loyalty and care. Can you imagine? What a different discussion. Then in the Netherlands, there is a soft law agreement of the 50 largest pension funds, and some of them, ABP also speak and ABG, and they pledged to integrate sustainable investments in a certain way into their program. They even pledged to also integrate member preferences into their investment program. So the regulator says, if you sign this pledge, if you sign this agreement, we will also make sure that you keep up to this agreement. So the regulator is already involved in looking at this. In the middle, you see a document that shows that there is benchmarking going on the topic of responsible investing in the Netherlands as well. This all led to the fact that many Dutch pension funds started doing surveys, interviews with their members. Some of them did not do that because they didn't sign the pledge and they don't believe in it. But of course, if you do all these interactions with your members, I don't have to tell you, there's a lot of bias potential, like social desirability answers, selection bias, representation bias. So the question that we academics pose ourselves, how do you elicit the preferences properly? Coincidentally, one of the funds, the pension fund for the retail sector, connected with us, and it's a big fund. It has a very simple strategy, public investments in all asset categories that you can do that, and passively, very simple. They had a limited exclusion policy. Controversial weapons are excluded, nothing else. They voted by proxy on their whole portfolio based on their own internal voting guidelines, and they had a private engagement program through BMO. And they have the explicit on their website investment belief that the integration of sustainability can be implemented without compromising key portfolio characteristics such as risk and return. That's the belief. So they approached us and we did 2 field surveys with them, study 1 and study 2. In 2018, the board of that fund granted its participants, its members, a real vote ex ante on the sustainable investment policy. There was a question posed to all participants, all million participants. I mean, in this case, it was just the active participants, 250,000. They got the question whether the engagement program should be intensified, more engagement, and extended by more topics, in this case, to a 4th additional sustainable development goal that connected to the culture and context of the company. Close to 70% of the participants said yes to this, only 10% against, and 20% didn't know what to answer. Even when they expect that engagement hurts the performance, they said yes to it. I'm going to give you some information on that in a minute. The Board of Trustees actually executed this vote within 1 week after we as academics published our results in a formal paper. In a second study, study 2, that was done during COVID last year in June, we show that strong preferences remain stable even in this COVID context. It has a negligible impact, which we would also expect from psychology. Preferences do not change that quickly. It's not something that changed from 1 year to the other. I want to summarize these results very briefly. So we had 2 studies, as I said, one in study 1 in 2018, study 2 in 2020. And in both studies, we checked whether these participants like the topic of engagement to be extended or whether they want to have more screening in the portfolio, which we label screening is essentially the same as ESG integration. So in both studies, more than 50% of the people said yes to engagement and yes to screening. But this is the average. And what is more interesting is how heterogeneity kicks in. And I'm going to give you some information on that. So we asked people also about their beliefs. So the question was, do you think that through sustainable investing, retirement benefits will be in the end higher, equal or lower, or even much higher or much lower, or don't you know? So then 20% of the people said, well, I actually don't know what to think of this. But the other 80% had a quite, well, equally distributed almost between higher, equal and lower expectations of the retirement benefits because of the decision made over there to engage more or to screen more. So in gray, you see the screening, and in red, you see the engagement result. Fairly distributed. What is interesting, if you go to the right-hand side of this slide, you see the same division of categories, so much lower until much higher, and I don't know, but you also see how these categories voted. So those that expect much higher returns obviously said, yes, let's do the screening because I expect higher returns. But even the relatively large group of 25% over here on the left that said lower returns, still more than 60 and even more than 80% of the people said, let's do the engagement and let's do the screening. Only for the smaller group of 5%, 7% of the people that said much lower returns, they said, let's not do this extension of engagement or the extensions of screening in our fund. In the end, the fund decided that the average of 50% was the threshold. And bear in mind, this is a defined benefit fund that we're talking about. People cannot make a decision themselves to go in or out. Then finally, the COVID, similar question. We asked people what they think of COVID and the impact on retirement benefits. Again, much lower to much higher. And you see that most people think lower or equal or much lower. So there's a more of a negative expectation. And again, bear in mind, this was asked in the COVID period in June 2020, actually as a robustness test for our academic paper, because if you do studies and surveys in such a period, you need to show that your results are not hampered by it. What we found is that still the large majority of people said yes to both engagement and screening. However, there is a group of between 10 and 15% that says, well, let's not engage on the same basis that was proposed by the board of the fund, because it might lead to lower returns. So what can we learn from this? Knowing the preferences of your participants in the pension fund context, but I would argue the same holds for mutual funds, is really important, because these preferences have a significant influence on the decisions made by individuals. In a pension fund context, in a defined benefit context, a defined contribution context, a mutual fund context, an insurance context, doesn't matter. If you know what people's preferences and beliefs are, it will help you. Research also shows, and I think that is interesting for the commercial people in the room, is that consumers of financial services who stronger identify with their service providers, that's more out of the marketing literature, the financial services marketing literature, those consumers are more loyal. So if you provide them with the products they want, whether it's the mutual fund context or the pension fund context, they are more loyal. Interesting observation in my view. And I think in a time when trust in the financial sector has plummeted after the global financial crisis, better understanding what beneficiaries want is really important to bring confidence back to the sector. Because it's essentially, especially in a pension fund context, your most valuable asset. With that, I conclude, I guess, within the time. Thank you very much.